fellow investors. Welcome to another episode of Ritter On Real Estate. I'm your host, Kent Ritter, and today, very excited to have Yonah Weiss on the show. I've known Yonah for a number of years now. He is, I'm sure you guys know who he is. Everybody I know knows who Yonah is. But I'm excited to have him today. And because every time I get a chance to talk with him, I learn something or I get connected to somebody that I needed to be connected with. So Yonah, excited to have you here. He's a business director with Madison SPECS. He is the cost seg king, as most people know him. He's a fantastic people connector, as I can attest to. He's the host of the Weiss Advice podcast, and he also hosts a virtual meetup called Real Estate Connections. And so, again, just everything he's doing, bringing folks together. So, Yonah, thanks again for being here today. And let's start with just let's let folks know a little bit about who you are. So, give us your background, kind of how you got to where you are today.
Sure. Thanks so much. I appreciate you having me on the show, Kent. Always a pleasure as well to spend time and talk with you. I love going on podcasts because you get an opportunity to speak to a whole new audience who, as you mentioned, people may have heard of me before, but I'm sure there are plenty that haven't. So happy to be here. A little bit about me. As you mentioned, my main occupation now is cost segregation. I work for the largest cost segregation company, and that's what I do, a full-time job. But it wasn't like, when I was a kid, it was like, hey, I want to be a cost seg king when I grow up, right? It's not something really people think about or talk about, but I was a teacher for many years. Really, my passion has always been in helping others and teaching for 15 years. I have a family, 6 kids, so I'm always teaching, like at home and on the road, wherever I go. But at a certain point, I realized teaching, as much as I love it, and I started a nonprofit organization to help needy families, but I realized it's very difficult to make a good living, especially with a growing family. And I reached out to some friends of mine and was like, okay, what can I do to kind of get some more income or get some, maybe another career of sorts? And real estate was the industry that just jumped out because it was something that you could do without any additional formal education, which I wasn't interested in doing at that time in my mid-30s, early mid-30s. And also, it was something that had a lot of potential. I mean, not just potential for income, but potential for, growth. And I realized quickly when networking, as you mentioned, something I love to do, I started meeting such incredible people in the real estate industry and did a bunch of random kind of odd things just to learn everything about, commercial real estate and residential as well. So I was a mortgage broker for a little while, commercial mortgages, did some rental, a few fix and flips and some residential brokerage just to kind of get my feet wet and figure it out, like from what everyone else is doing and seeing it from both perspectives, both the investing side as well as the kind of servicing side of lenders and, working with banks and working with brokers. So I kind of saw a lot of different perspectives. And at a certain point, I was reached out to by this company, Madison Commercial Real Estate. And it was just like a perfect fit and opportunity to get into this cost segregation company that was growing fast. And I just really fit into a role of education, which was something that my passion was always about, is just really teaching people, because I realized here's this topic that is so incredible once you know what it is, but most people don't know what it is, right? And so it's like, okay, here's this awesome opportunity to teach as many people as possible, help as many people as possible, and simultaneously investing, getting to know other the clients, sponsors that I'm working with. And ultimately, I've grown a tremendous amount, like you said, through the networking, through the podcasting, through the meetups, and through investing. So I'm very grateful to be where I am.
That's awesome. And it's a cool story. It's, I'm sure there's other industries like this, but it just, the thing that I think strikes me about real estate, at least like the area of real estate that you're in and I'm in, right? Kind of the maybe multifamily real estate, that's not the huge institutions, right? That's a lot of individuals or groups of people that are out there doing it. I don't know, probably 90% of the people, maybe more, it's their second career. It's kind of their second life, right? We've all come to it from something else. And I think and so for some reason I've been thinking about that. I don't know, over the last like week or so, as I was just at a conference. Well, I saw you at the conference actually. And I was like, man, yeah. Cause you talk to people, it's like, oh, what did you do? Oh, I was an accountant. I was in construction. I was something else, right? Teacher. But I think it is because of those opportunities that you described. I mean, real estate has changed my life too, right? I mean, it's given me the financial freedom that I didn't think I'd be able to have. It's the ability to work when I want, where I want, right? Be able to start my own company and kind of build that and help other people, and both employees and clients. And it's just, yeah, it's just incredible. And I think it's probably a lot of our second careers because, like you said, it's not that well known. I mean, that's what always strikes me. And that was why I started the podcast too, because like when I learned about this whole world, because what I thought real estate investing was, because it's the only thing I'd ever been exposed to, was you buy a single family home and you become a landlord. And everybody I knew that was doing that, like they hated it. They didn't like it. They're like, oh, this guy called me at 2 a.m. His toilet's broken and blah, blah, blah. Right. That never appealed to me. I didn't learn until, I was in my early 30s too, of a different world, where you can buy large apartment buildings, you can invest with others, and you can do it passively, and you can build a portfolio and syndicate and do all these different things. Like, I just had no idea. It's not exposed in that way. So I guess those are kind of my like theories I've been thinking about of like, there's so many people that have come to it as a second career, and kind of why that is, and why more people don't just start like right away,
Yeah, I mean, I think I agree with you on the thing. People think about real estate and think about being a landlord and having tenants. And my parents actually own like a few out-of-state rentals. And even though they have like, property managers dealing with those single families, but they still had problems. Like one time, like the pipes, the infrastructure pipe like broke, and they had to pay like $10,000 to get that fixed. So they had no cash flow from that property for the year. Right. And there's little things like that. Like, okay, that doesn't interest me. Like, I'm not interested in that at all. It's just like a headache more than anything else. And, but one of the things that I agree with you and see the common denominator with a lot of people in this space is that they're kind of growth oriented people. And so it takes a growth oriented type person to be able to make that shift in life, to say, okay, I didn't enjoy what I was doing before, or maybe I did, but I want something more, and I want to be able to give back, and I want to be able to take more grasp of my life and my time and spending time with my family, et cetera. And so that's kind of the people, like you meet all these people at the conference, like everyone's into that. Everyone's into growing, being a better person. And I think you able to grow a business properly and help people and investors if you're really truly fixed on the fact that you want to be a better person.
Yeah, I think that's a great insight. I think that is a common denominator, and I think that growth mentality is absolutely right. And whether you're doing it like full time and you've kind of dove in like we have, or you're investing passively, like we were talking a little earlier on the show, like even quote unquote passive investing is a very active thing. You have to have that growth mindset, I think, even to do that, because you have to be willing to learn. Like, you got to educate yourself to be able to make good investments. That's what this show's all about. Right. But yeah, you can't just be willing to kind of sit on the sidelines, give your money to somebody else and kind of hope for the best. You gotta be willing to take control of it. And I agree with you. I think that does take that growth kind of mindset. So yeah, well, listen, you're the cost seg king. So I'd be remiss if we did not talk about cost segregations. And it's been a while since we've had somebody on the show to talk about a cost seg. So I think we should start at the beginning. Just tell the listeners, what is a cost segregation, and how does that fit into a real estate investment?
Sure. Let's just start from the beginning. I mean, cost segregation, it's a weird name that the IRS gave to this deduction that is really depreciation. It's an advanced form, or like a very complex form of depreciation. So depreciation, let's take a step back and just understand what that is. Anytime you buy a property, as long as it's not your personal residence, if it's a rental or business property, anything like that, you get a tax deduction from the IRS that's called depreciation. And depreciation, even though it sounds like a negative thing, something going down in value, you have to remember it's just a borrowed term. This is something, it's a deduction that's named after the, borrowed term for something that goes down in value as time goes on. So we're going to give you this deduction on your property when you buy it, as if your property is going down in value. So you can kind of write it off, even though it's not so. I mean, obviously most properties are going up in value, it's appreciating. Nevertheless, that's what depreciation is. But typically speaking, it's given over a long period of time, meaning you could take the property value that you buy and then write that property off, meaning reduce your income taxes over a 27.5 or 39-year period, which is a long time to wait to get like all these deductions. Cost segregation is a method of breaking down the property into different components, or segregating the property, right, into these different components, and seeing how there's actually individual things in the property that actually depreciate or go down and you have to replace over a much shorter period of time. And the IRS gives you the ability to take that deduction at a faster rate. So for example, stuff like furniture or fixtures or appliances or even shelving or window treatments, anything that's non-structural in the property, even carpeting or flooring or cabinets, all that stuff's non-structural that actually depreciates according to the IRS on a 5-year period. The method of cost segregation is identifying through an engineering study what those individual components are and what the value of them are, and then taking a tax deduction for those values at a faster rate at that 5-year schedule. So you can actually take those deductions up front.
Gotcha. I think that was good. That was good. That's a lot to cover.
There's a lot. Yeah, there's a lot there.
So that's what it is, right? You're accelerating the depreciation schedule. You're able to take more depreciation, really, essentially in the first year, right? That's the big bump of when people see that. But now, so we know what it is, but why should an investor care about that?
Excellent question. So any investor, right, gets a portion of that deduction, just like you get if you are, an owner in an investment. Obviously, it does depend on what type of investment it is. For most people, we're talking about passively investing in a syndication. Generally speaking, you own equity in the property itself. You own actually a portion of the property. And as such, you not only get the cash flow or get the returns on your investment, but you also get proportionate to your investment, the deductions as well. So this depreciation deduction is going to be allocated among all the investors. And so it's a cash flow tool, essentially, that during the life of ownership, here's a great strategy that you can not only get your return on investment, but it can be literally tax-free during that time period. There's an added benefit for anyone who is a passive investor that's also a real estate professional, that you can actually use these deductions against active income as well. But that's maybe for a follow-up.
Yeah, I mean, it is a fantastic benefit, but now that I qualify for that, but I think that is something that people should look into. What is a real estate professional as the IRS defines it, and how might you qualify? Because that really is a game changer when you can offset all of your income using this depreciation strategy. And so, right. So I guess, remember, guys, as we just go back to, why do we love commercial real estate, right? It's non-correlated. It's not correlated to the stock market, right? We want a diversified portfolio that is non-correlated, meaning if the stock market goes down, the value of your real estate does not also go down, right? They don't move together. That's number one. You got to build out a good portfolio just across all of your assets. But why do we love commercial real estate? Well, it cash flows, right? It appreciates, and it saves you on taxes. It's tax advantage. And this cost segregation study that's done, and that bonus depreciation that you're able to get, is the major driver for that piece of that tax advantage piece of why we love commercial real estate. So really important to understand what it is. Mm-hmm. And so, Yonah, are there certain questions, like as a passive investor, that that folks should be asking if they're evaluating deals, if they're evaluating a sponsor, to know that, I mean, obviously, do you do a cost seg, but is there anything deeper than that that folks could ask to know that, hey, this person knows what they're doing?
Yeah, I mean, it's a really common question, especially nowadays since the bonus depreciation law came about. And we can talk about that for a minute as well in a second.
Yeah, that'd be good.
But one of the questions that I get a lot from my clients is, and who are syndicators, is their investors want to know, are you doing a cost segregation? Number one, but number two, is there a way to figure out how much deduction I'm going to get based on that investment? And that's more important for someone who is a real estate professional or their spouse is a real estate professional, because that means they can use massively, right, this amount to not only offset their rental income or from other investments, but also to offset active income. But I do get that question a lot. It's important, but it's also important to realize, because if you have a syndicator who is doing a cost segregation, you know that they are going out of their way to, right, take advantage of these tax strategies. Meaning that they're not someone just necessarily new to the game, right? It's something that does come with a little time, a little more experience to know that these things do exist. And it really is looking out for investors, especially because you want to make sure that they can use these deductions and that they can get their best interest from the returns on their investment as well, which kind of leads me to, that thing about the bonus depreciation, which was a new law that, as I mentioned before, the cost segregation is a great way to kind of front load some portion of those deductions to the earlier years. And I had mentioned the 5-year category that's called personal property, things that are non-structural inside the building, depreciate on a 5-year schedule, but there's stuff outside the building also called land improvements, anything like landscaping or pavement, concrete, fencing, anything that's outside of property, essentially. That's called land improvements, depreciates on a 15-year schedule. A few years ago, with the Tax Cuts and Jobs Act, they're introduced a new law called 100% bonus depreciation, which allows the taxpayer, allows the property owner to take 100% of those faster deductions in the first year. So instead of, waiting 5 years or waiting, 27 and a half years to take, a deduction each year, an equal amount over that period of time, you could use cost segregation to front load maybe 20-30% of that into a 5-year or 15-year category, which would give you faster, bigger deductions during those first 5 years. But you have now the option to take all of that upfront in the first year. So just to give you a picture of what that actually looks like, if you buy like $1 million property and you're able to take 25% of that upfront in the first year, that means you could literally put down 25% down payment, $250,000, and in the first year, get a $250,000 tax write-off, right? So literally dollar for dollar, how much you put in. It's an incredible way to, like I said, give that return on investment a higher amount.
Right. Yeah. No, and I appreciate you explaining that bonus depreciation piece. And I mean, is that something that we expect to stick around for a while at this point? What's been the latest guidance on bonus depreciation?
When it was enacted, it was already only enacted for a temporary period of time. So it was set to phase out, and still is, as far as now. Nothing's been changed since that 2017 tax reform, but it was set to phase out starting in 2023. So it's going to go down to 80% bonus and then down to 60-40 until it's totally phased out. And there will still be cost segregation, which has been around for 40 years or so. But this bonus depreciation law, as far as it is right now, we'll see what happens in the next couple of years if anything changes. But as far as now, it's still around, but it's going to start phasing out in the future. Gotcha.
Okay, I didn't realize that. And so as you talk about that and you talk about the depreciation, some folks may just say, well, no, I really don't. I'm just making a passive investment. I really don't need, all of that depreciation, but it carries forward. So if you have extra depreciation that you're getting in year one that you're not using, it will carry forward and offset against future gains, future passive gains. So it becomes very effective in a real estate portfolio when you get to the point where you're invested in deals and those deals now start to sell, right? And as long as you're selling and then investing in new deals in that same year, those will offset, and you can use that new depreciation to offset gains from that sale. And so you can have a very effective tax strategy just from continuing to invest without having to go into 1031s and different different kind of vehicles that may not be open to you as a passive investor. Just by going through the process of continuing to make good investments, you can offset a lot of those taxes and continue to really kind of kick the can down the road from a tax standpoint.
Exactly. And I think a lot of people don't understand that. And there are so many different factors that can really be played out that can affect an investment. So we are talking really general here. And I do want to point that out. Obviously, this is not tax advice. You want to, speak to your CPA. You just need to make that disclaimer, but there are a lot of factors that can either help or hurt your situation, depending on, like you said, if you are continuing to invest or reinvest, you can, especially if your sponsor is using cost segregation, you can continue kind of kick that can down the road and use these investments, get those returns, and continue doing that in a tax-free, kind of tax sheltered way for as long as you can.
Yeah, I think that's, and it's one of the best kept secrets in real estate, right? One of the best strategies is continuing to invest and continue to offset those taxes. And, I think from a sponsor standpoint, deal sponsor standpoint, so from somebody who's buying and syndicating properties, I think just one of the pro tips, one of the next level things that you can look out for is, the depreciation doesn't have to be distributed just related to your equity percentage, right? It doesn't have to follow that. That's the most common way. It will be distributed based on your percentage of ownership. Mm-hmm. But you can actually through the operating agreements, if you're thinking about it ahead of time, you can shift depreciation more toward the folks that can really benefit from it and away from folks that can't benefit from it, such as if folks are investing with their solo 401ks or their self-directed IRAs, and the depreciation expense really doesn't do anything for them because they're already in a tax advantaged vehicle. You can actually shift their depreciation over to the investors that are investing with cash and give them extra share of depreciation. So I think that's kind of like a next level strategy that can really show you an advanced operator.
100%. And it, like you said, it must be done the right way, but ask about it because, especially if you're someone that's looking to invest a large amount of capital and looking for the best tax advantage way to do it, you may have an operator that will be willing to kind of work with you. If it's just a small amount, less so probably, but I've certainly had scenarios where they've been able to work out a type of operating agreement, and they were able to, through different structures, work out a way to shift the depreciation or allocate more of that to certain people that could use it more. Yeah,
really good. So Yonah, I want to switch gears a little bit here. I think that was a good cost seg overview. We don't want to get too deep and blow folks' hair back here, but if folks, we'll give your information after the show, so if folks are interested, they can dig deeper. I want to talk about networking though, because I know it's something that you're really passionate about, something you're very good at. I've participated in some of your events that you do on LinkedIn. It had tremendous impact on my reach on LinkedIn, for lack of a better word. Mm-hmm. So I want to talk about networking because while we talk a lot to the passive investors on this show, one of the common themes that I always try to get across is, even though it's called a passive investment, you got to be active in it. And I think one of the most important ways to be active is by networking, because one of the most important things you do as an investor is you meet good sponsors, because that's how you get good deals. And so while I have you here, I'd love to just hear kind of your perspective on networking, why you've decided to pour so much time into it. Give us the case study of what that's meant for you in your life, right? As the proof point. And then I'd love to hear some tips on how folks can be better at it.
I'll start with the last question first, because I think
Okay.
that's really, for me, it all starts with the foundation. And for me, the foundation is all about networking, and in business in general, marketing in general. And this applies to everyone. So it doesn't matter who you are right now, where you are in your life in general. This is what I kind of live by and stand by, is how can I help other people? How can I add value? How can I go out of my way to see what other people need before myself, right? And so there is some selflessness to that, and it's not something that necessarily going to come easy for some people, but that's the key to everything. And so networking specifically, when you're out there meeting people, whether that's online, whether that's, like you said, LinkedIn, and using social media to meet people, which I love, because I feel like LinkedIn and other social medias can be literally like a 24-hour, networking event, 24/7 or 24/6 for me. I keep the Sabbath, so I'm off online for one day a week at least. But for me, it's incredible because you meet so many people from all walks of life and from doing so many different things. And if you're thinking about, well, how can I help them? You're keen to listening and really trying to figure out, well, what do they need? Who do they need to meet? Like, who's going to be a good person for them to connect with? And then making those introductions or making those connections, that can literally change people's lives. That can literally change their business. That can do so many things for them. I mean, there's been countless times where people have asked me my opinion on, do you know good sponsors to invest with, right? And because I work with hundreds of syndicators and real estate investors across the country in every asset class, I just have had personal experience, and I passively invest myself. And so I know some, and happy to recommend those who I honestly believe are good people and are really care about their investors and have really good investments. They're not just looking out for themselves. There's some, syndicators out there that you can tell they're kind of more focused on themselves. Like you mentioned, there are some bad apples out there, and you got to be careful. So that for me has been the biggest kind of foundation in what I've done. And I literally it's changed everything for me. I mean, that's what really got me started in the podcast circle to begin with. And then the networking events in person and then online. Once COVID hit, we started almost immediately. We saw there's no more in-person events for the foreseeable future. I saw a couple other people doing this, and I jumped on it immediately and started this weekly virtual Zoom meetup. And we're going, 18 months already, going almost 2 years, every single week, a different speaker, a different topic, and a lot of people coming back every single week. And certain people from that they've met partners, they've met one guy literally got a new job from that. He's now a partner in the company he works for from that meetup. People are investing together. There are some brokers in there. They've met, gotten deals from that, from people, just brokers and lenders and all kinds of things. And it's just putting yourself in the room, or in the virtual room in this sense, with other people who are, going back to what we're talking about before, growth minded people who want, they're going out and they're taking time out of their busy day or their evening. For me, we do it at 7:00 Eastern. So for some people, that's like, that's a hard time for a lot of people, but they take it seriously and say, this is a real opportunity, not just to learn, because we do have some really high quality speakers, but to really network and get to know people through that. And so, I mean, it's been game changing. I mean, to say that, use that kind of cliche word, but it really has.
Yeah. And I think that's fantastic. I think it's a great case study. I think I've seen some of the impacts just in my own life of, we host a local meetup here in town, and it's so cool when you see folks meet in it and you see deals get done through the meetup. Like we have one example where it's like, the buyers, the sellers, and the brokers in one deal all met each other through the meetup. And I just think that's the coolest thing, of being able to see that happen. And like you said, how you kind of change people's lives in that way. And so to do that, like, you have to be very active, right? You are
Right.
very active in it. You spend a lot of time investing in your network, right?
Mhm.
For folks that are more the passive investor, right? They're busy professionals and they got a lot of other things going on, but they want to make good real estate investments. They need to meet good sponsors to be able to do
Mhm.
that. I mean, what are some ideas for folks where maybe they could spend 15 minutes a day? They can, how can they be most effective?
It all comes back to, obviously you're right. Everyone has different schedules. Not everyone can spend, as much time as I do on these things, but you, like you said, you have to be active. Even as a passive investor, you have to be active. You have to be going out of your way to try to meet more people and meet other passive investors. So maybe look up, Bigger Pockets is a great way. On LinkedIn or Facebook, there's a lot of Facebook groups out there, these kind of private groups, and you can search whether it's local to the place that you live in or just in general, multifamily, etc. You can meet people through those, and you kind of get to know especially if you go to some of these virtual meetups that are out there or in-person meetups, like you said, you're going to rub shoulders, you're going to be in the room with those people. You're going to make changes based on to your life in whatever way that you want to, based on the people that you spend time with. And so even if it's 15 minutes a day, that's not a lot, but that can be a significant amount in terms of finding the right people. And if listening to podcasts is a great way as well, you definitely meet people that way, and just find out about new people. Wow. I mean, I never knew that you could do things like, infinite banking and all these kind of, different things, using life insurance to invest, just random things that you would have never heard about had you not found a podcast. And I say I'm shocked, but I'm not. Like, at this point, doing this for as many years I'm doing cost segregation, there's so many people that have never heard of it before. And the first time they ever hear about it is through a webinar or through a podcast or through a meetup that I'm at. And to me, it's like, okay, now I'm doing this. So for you, talking about multifamily investing and passively investing, for some people, they never knew that existed. And so keep doing that. And so surrounding yourself with those type of people, because even those busy professionals, guess what? They want to leave a nest egg, right? To leave some wealth behind for the next generation. And so you gotta be proactive to help educate as many people as possible.
Right. And I think that being proactive, you hit the nail on the head, where, if you're, so the easy way, which the easy way I've learned in life is never the best way, is you hand all your money over to somebody and you say, man, I hope that works out. And that's your retirement, right? And you just kind of say, well, I hope it works out. The harder way, that takes more time, the more difficult way, is to actually take ownership of, like you said, your nest egg and your retirement and what you're going to leave behind, and actively manage that part of it. I mean, it's, I think oftentimes we can give way too much credit to folks that have, certain titles or things, or that you would want to give your money to. I mean, I just always go back to, and maybe I shouldn't say this, but, you ask in a lot of these places, you ask them, a financial advisor, well, how many people in your firm, or do you know that have, been able to leave their W-2 job or be financially free and build that wealth? And the answer is none, because they're all still there. So my whole point is there's a different path. And the path is, I think, to take control of your own finances, investments. Part of that is real estate. I'm not going to tell anybody that all of it should be real estate, but the proactive piece, I think, is what I want to get back to. And the way that you're proactive, and it starts with networking, it starts with meeting the right sponsors, because what we've talked about 100 times on this show is it's the sponsor first, right? A good sponsor can save a bad deal, and a bad sponsor can kill a good deal. And so before you start looking at markets and properties and things, like, just start with the sponsor network, find somebody that you resonate with. Podcasts are a great way to do that, right? That was how I first got introduced to a lot of different people. And so I think networking, I think listening to podcasts is a great way to start.
100%.
Yeah. Well, Yonah, I appreciate all the wisdom you've given us thus far. Before I let you go, I want to take you through our keys to success round. I'm going to ask you 4 questions. The first one is put your passive investor hat on, in those deals that you've done. If you could only ask that deal sponsor one question, what is that? What's the most important question?
Here's a question that actually asked one time, and it was in a situation where the deal had gone awry, right? For no fault of the sponsor. There were things that happened that, but this is a question that I think is a good test to see how a good sponsor would respond in a, I don't want to say like an emergency situation, like something totally out of control has happened. What would you do? So the question I would ask is, would you more likely, to save a deal that's gone through, something like this? And the case that I'm talking about, one of the other sponsors actually had like a medical emergency and was totally out of commission. And so there was no way that they could be involved anymore, which really had a dampering on the entire deal because that person was running a lot of stuff. So it was difficult. So for one of the other partners, the question was, what do you do? I mean, do you bring on an expert? Do you shell out your own money, right, from your own pocket to cover the situation? Do you do a capital call to ask investors to come back out? Meaning, how would you deal with an emergency situation? And you don't have to go into details like the multiple choice that I gave, but I think seeing how a person functions in an emergency is really important.
Yeah, I agree. I mean, I say all the time, I think real estate is all about solving problems. I mean, some of those problems are bigger, obviously, as you described, than others, but it's all about solving problems. I mean, that's really what it is. I mean, as somebody who owns property, just things always come up, and it's all about how you deal with them and stay calm and level-headed and always have contingency plans. I think that's a huge lesson learned. Well, awesome. That's a good question. Next one is, what are you most proud of in your career?
I think giving back, right? Being able to give back. And I do that in many different ways, but just the ability to meet as many people as I've met is just allowed me to give back to more people.
Awesome. What's a book that everybody should read?
If you want to learn how to network well, since we spoke about this topic, I'm a big fan of the networking prowess of Gary Vaynerchuk. And so he's got a great book called Jab, 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 Right Hook. And that book really kind of opened my eyes up to how to add value through networking and through marketing. And so that's just an incredible perspective.
That's great. I'm gonna have to check that out. I like Gary V. And lastly, Yonah, what is your number one key to success?
I think it has to do with humility a lot and really knowing that you don't know everything and just be open to learning and being open to listening. And so to me, that's success, because for me, I define success not monetarily, but rather for how much of an impact I can leave and how many people I can affect. And so doing that, you have to be very humble because you have to be thinking outside of yourself. And that, to me, that's the key element.
That's awesome. And I think we see that through your daily work. So really living the message. Yonah, thank you so much for coming on. If folks want to learn more about what you're doing, how can they reach you?
Best way to find me is on LinkedIn. That's where I'm most active. Give me a little connection request. Tell me that you listen to this podcast, and I'm happy to connect with you. You can also go to yonahweiss.com if you want to learn any more about cost segregation.
Awesome, Yonah. We'll put that in the show notes so folks can reach you. And thank you again so much for coming on the show, and have a great rest of the day.